Welcome to the deep dive. Today, we're really getting into something important in financial reporting, the fair value option for financial instruments. Now, this isn't just about ticking boxes for accounting rules. It's actually about a choice, a strategic choice companies make about how they show certain assets and liabilities. And believe me, that choice can really change the picture you see on the financial statements. Before we properly dive in, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, the examples, explanations, everything we talk about today comes from the accounting resources over at farhatlectures.com. So whether you're studying accounting, prepping for the CPA exam, or you're already a professional, definitely check out the website. They've got extra practice questions, video lectures, lots of support for today's topic. And a special thanks to Professor Farhat for providing all this great material. Okay, so we're talking about this choice. And the big question, I think, is this. Why would a company choose to show its investments at what they're worth right now, at market value, even if that makes their earnings jump around more? What's the thinking there? What's the trade-off? Let's unpack this. We keep saying option choice. For our listeners who already know a fair bit, the interesting part isn't just that it's a choice, but what are the real implications of having this kind of significant accounting choice? So what exactly does fair value mean here, and how is it really different from what we might normally expect?
That's a great starting point. Yeah, the fair value option immediately signals we're looking at something quite distinct from traditional historical cost accounting. Instead of just recording an asset at what you paid for it and maybe depreciating it like, say, property, plant, and equipment under U.S. GAAP, fair value demands you look at its current worth. How much is it worth today? And this applies specifically to financial assets and liabilities, things like stocks, bonds, certain debts. The company is basically choosing to put current market reality right onto its main financial statements. It's a significant move.
Right, so it's about today's value, but finding that value, that's not always just a quick search online, is it? Especially for maybe more complex things. How do companies actually figure these values out in practice?
You've hit on the real practical challenge there. I mean, for our discussion today, we'll assume the fair values are given, but yeah, in the real world, it can be complex. There's actually a hierarchy, sort of three levels for how you determine fair value. Level one is the best, most reliable. That's when you have quoted prices for identical assets in active markets. Think about major stocks, Amazon, Zoom, PepsiCo, Coke. You can easily find their prices on Bloomberg, Yahoo Finance, wherever. No debate there. Then you got level two. This uses observable inputs, but for similar assets, not identical ones. So maybe you're valuing a bond that doesn't trade much. You'd look at similar bonds, similar credit ratings, maturities, that kind of thing. Or like valuing a house by looking at recent sales of comparable houses nearby. Still market-based, but needs a bit more judgment. And then there's level three. This uses unobservable inputs. This is where it gets, potentially tricky. Companies often have to use their own internal models, like discounted cash flow analysis, to estimate the value.
There's a lot more management judgment involved here. And, investors really need to look closely at the disclosures about how these level three values were calculated. History shows this can be an area open to, let's say, interpretation.
Yeah, that level three subjectivity, it immediately makes you wonder about the why again. Why opt into something that could be seen as less objective, even if it reflects current value? So, okay, a company decides to go for this option for a particular instrument. What are the absolute core rules then? How does this actually play out on the statements?
It's a big decision, absolutely. And once they make it for a specific asset or liability, there are some key rules. First, and this is really the headline difference, all the changes in fair value gains and losses, whether you've sold it yet or not, they go directly into net income, straight to the bottom line. Nothing goes to Calbiche. Other comprehensive income, OCI, if this option is picked. Now, usually OCI kind of buffers some of that volatility, right? Like for available for sale securities, those unrealized gains and losses sit in OCI, not hitting net income immediately. But with the fair value option, nope. You choose to let that market fluctuation hit your earnings right away. Why do it? Well, sometimes it simplifies really complex hedge accounting. Or maybe the company genuinely believes showing current values and net income gives investors a better, more relevant picture, even if earnings look a bit more jumpy. Second rule, it's applied on an instrument-by-instrument basis. This is crucial. It's not an all-or-nothing choice for your whole portfolio. You could buy, say, 3 different bonds and choose the fair value option for just one of them, maybe keep the others as available for sale, or held to maturity if appropriate. You pick and choose for each specific item. And finally, the decision. You have to make it right when you buy the asset or take on the liability. And once you've chosen the fair value option for that specific thing, you're generally stuck with it. It's binding. You can't flip-flop back to historical cost just because the market moves against you. You use fair value until you sell it or it matures or whatever.
That binding part really does emphasize the commitment, doesn't it? Okay,
Yeah.
let's make this really clear with maybe a couple of examples. Let's say there's Adam Company. They buy $100,000 worth of bonds. Now, if they didn't choose the fair value option, maybe they classify them as available for sale, AFS. And we just said AFS changes usually go to OCI.
Exactly. That's the standard AFS treatment.
Yeah.
But here's where the fair value option completely changes the accounting. Let's say the market value of those bonds goes up to $112,000. That's a $12,000 unrealized gain. Because Adam Company elected the fair value option for these specific bonds, that entire $12,000 gain, it flows directly into net income. It shows up as something like unrealized holding gain income, OCI is completely bypassed. The journal entry is pretty straightforward too. Debit an investment for $12,000. Credit that unrealized holding gain loss income account for $12,000. Boom, right on the income statement.
Wow, okay. That's a stark difference from putting it in OCI. Definitely changes how you'd read their income statement for that period. Let's take another case, maybe one where it overrides a different accounting method. Say, Economic Integration Company owns a 32% stake in Farhat Lectures. They paid $850,000 for it. Now, normally a 32% stake, that implies significant influence, so you'd typically expect the equity method of counting, which is a whole different ballgame.
You're spot on. Normally, 32% means equity method. Economic Integration would record its share of Farhat Lectures' profit or loss in its own income, adjust the investment account. There's more involved. However, if Economic Integration chose the fair value option for this specific investment when they bought it, then the equity method rules are ignored for this purpose. Let's imagine the fair value of that 32% stake drops later to $800,000. That's a $50,000 unrealized loss. Because they picked the fair value option, that $50,000 loss goes straight to net income. It would appear as an unrealized holding loss income, the entry. Debit unrealized holding gain loss income for $50K, credit the equity investment account for $50K. So you see, whether it's bonds that might otherwise be AFS or an equity stake that might otherwise use the equity method, the fair value option forces everything through current market value, with the ups and downs hitting net income immediately. It provides a very different view of performance.
It definitely makes the accounting entries seem simpler in a way debit or credit straight to income. But like we touched on, the real-world challenge isn't always the bookkeeping entry itself, right? What's the biggest practical hurdle companies face when they actually try to use this option, especially thinking about those level 3 assets you mentioned?
That really is the crux of it. While the accounting treatment putting gains losses in net income is straightforward, the hard part is often determining that fair value number in the first place, particularly for level 2 and definitely for level 3 assets and liabilities where there just isn't an active market price. Companies have to use models, make assumptions, exercise judgment, and they can't just, pull these numbers out of thin air. Critically, they must provide detailed disclosures in the footnotes to their financial statements. They have to explain how they arrived at those fair values, what methods they used, what the key assumptions were. And this transparency is absolutely vital for users, for investors, because, well, as you hinted, subjective valuations, especially level 3, if not properly explained and scrutinized, could potentially be misused. So there's this constant tension, the desire for current market relevance versus the inherent subjectivity in finding that value. It's something anyone reading the financials needs to keep in mind.
That's a really important point, and it kind of brings everything together. So if we're summing this up for someone trying to make sense of a company's reports, the fair value option gives companies flexibility, a strategic choice for certain financial items, but it comes with very clear reporting rules. All the market value changes hit net income directly, skipping OCI. They basically accept more earnings volatility, maybe for what they see as better transparency about current value. But underneath that is always the challenge of actually getting that value right and being clear about how they did it, especially for the tricky stuff.
Precisely. Understanding this option isn't just about knowing the rule. It's about reading between the lines of the financial statements. It's about understanding the choices management is making about volatility and transparency and how that shapes the numbers you see. It really affects how you might assess their performance and risk.
Which leads to a final thought for you, the listener, to maybe mull over. There's this inherent tension, isn't there, between wanting to show an instrument's current market worth, which feels relevant, and the challenge, the subjectivity involved in figuring out that worth, especially for complex things. How might this optionality, this choice, actually influence how investors perceive a company? Could it affect the stock price? And what extra homework, what due diligence should an analyst do when they see a company frequently using this fair value option? Something to think about. Now, if you want to explore the fair value option more, or just solidify your accounting knowledge generally for exams or work, We definitely recommend checking out farhatlectures.com.
Yeah, FarhatLectures.com has a ton of resources, multiple choice questions, video lectures, detailed support. It's really geared towards accounting students, CPA candidates, and professionals. Plus, their CPA review materials align with all the major courses like Becker, Wiley, Roger, Lime. And they have something really valuable, access to about 1,500 old AI CPA exam questions with worked out solutions.
You can also find and connect with Farhat Lectures on social media. They're on LinkedIn, Instagram, Facebook, Twitter, and Reddit.
Keep digging into these topics. Keep learning.
Absolutely. Getting a handle on these financial details really is an investment in yourself. It pays off, trust me. Accounting knowledge, the CPA, these things will serve you well for years. Don't shortchange your